Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at another 5 high growth stocks today. Last video we looked at 5 different companies. If you haven't watched that video, go and watch that one first. And the reason I want to do this is because we talked about in that video the fact that a lot of the high growth stocks are down right now, and obviously as an investor you want to have a balanced portfolio, and depending on your time horizon, and I've talked about time horizon in this video, I think there. Okay, have a look at that one and see what you think about. You've got to invest based on your time horizon. So if you're in your 20s, obviously you need to look at this to some of those high growth companies. If you are almost retirement, you need to look into mature companies that are going to pay you an income of some sort, okay, whether it's dividend, whatever it is. Okay, so that's the kind of thing that I've talked about in that video. So have a look at that one. If you haven't seen the last video, also go and watch that one first. So in today's video, we will look at another 5 different companies. But before I do that, okay, I'm gonna talk about a couple of things, right? So in that video, I've talked about Cisco and Intel. I want to show you the chart to prove it to you it's actually possible. What we talked about was the fact that sometimes these high growth companies could be so overvalued, they will never go back to the point where, so for example, I'll show you what I'm talking about here. Cisco in the 90s were one of the best companies out there, right? People were saying, some basically analysts were actually expecting this company to hit basically $1 trillion by the end of that year. Genuinely, like end of 20, I think it was by 2020, 2001 or 2000, they were saying it will hit by 1 trillion. That was it. That was the headlines that were floating around at the time. The stock, on the other hand, went up as high as, let me show you where it was, almost to $80 per share. Guess what? It's actually never gone back to that stage. So around 2000, when basically the bubble burst in 2000, and 1999, 2000, look at what happened. It dropped to $15 per share. And since then, it's actually never gone back. The highest it's been is actually 2021, which is about 63 since then. So if you bought around that time, you would have lost about, let's say, $17 for every share that you own. And that's quite a lot of money. And this is why we need to be careful when you basically purchasing these stocks, especially high growth stocks that are still, room to grow and all that stuff. Be conservative. Look for companies that have lower beta, the companies that are, you understand the business and is not overvalued. Okay, and there's a lot of that out there right now. So let's look at the next company that we talked about, and this was Intel. Intel was, again, another great company. Everyone wanted to invest in this business, right? In the early 90s, $72, almost $73 per share at the time. Since then, the highest it's been is about $64 per share. So it's never gone back up to that stage. You would have lost quite a bit of money if you've actually invested in that time. So the reason I'm saying you really have to be careful is because history tells us if you don't, you're going to lose a lot of money, okay? You could win. Okay, there's no way, basically nothing wrong with that. Some people bought Tesla when it was about $2, $3 per share, and look at it right now. And talking about Tesla, I'm going to talk about 2 new companies now that are in this, basically reported their earnings last couple of days. The first one is Netflix. So Netflix, although it's not Sharia compliant company, and I don't own in my portfolio, I don't own Tesla either, and right now I've sold it out. But those 2 companies have actually reported. This one, Netflix, actually went down 35%, lost about 50 billion of market cap. 50 billion, that's a whole company. That's literally a whole company. And the reason for that is because they lost the subscribers. Okay, just in the last quarter, not even the whole year, it was just in the last quarter, the earnings basically report said that based on what the analyst was expecting, they actually lost a lot of subscribers. So for that reason, the stock market, basically the stock went down 35%. And today, I believe it's actually still going down, if I can find it. So today, there you go, another almost a 4% down today. So this sort of thing can easily happen. And this is why you really need to be careful when you're actually purchasing stocks, okay? Tesla, on the other hand, actually reported a great earnings. Okay, so you could be a Tesla owner and win big, or you could be a Netflix and lose a lot of money. So you just have to have that balance in your portfolio and just make sure whatever you do, regardless of whatever happens, you have profit, basically a margin of safety, especially with these high growth companies. Because if people think it's not growing the way they want, you could lose a lot of money. Will Netflix ever go back to the $700 it was not long ago? I don't know about. Okay, I don't know about that, to be honest with you. Right now, I'm actually a little bit not sure. Okay, will Tesla go down 17, 13, 20, 30%? Sure, I'm sure it might happen one day. All it takes is they might miss the numbers they're supposed to report every single quarter, and then the margins might go down because of inflation, because of this and that, because of, I don't know, China shutting down, whatever the case might be, okay? And these things could happen. So any investment is a risk, but you really have to be careful. Don't put £20,000 of your money into just one stock or whatever. That's what I would do anyway. Remember, I opened this channel because I want to share my journey. And as time goes by, I will share my opinion on certain things. And this is what I think. Okay, again, what I think doesn't really matter is what you do with your hard-earned money. And for now, let's see what the companies. So today's video, I want to look at some of the companies that are safe. Okay, last video we looked at some of the companies that are a little bit speculative, some are really safe. In today's video, we're going to look at companies that are safe. Okay, and the first one is KLA. KLA is basically in the semiconductor company. They do a lot of the process monitoring, diagnosis, and control systems for the semiconductors. So all the companies like Intel's and Taiwan Semis and all that stuff, they provide those equipment that these companies need. They're currently trading at $341 per share, PE of only 17. Price to free cash flow here is only 19. Okay, so which is really good because we're looking for less than 20. In terms, I think the sector is about 26, 27. I think it's about 26 or 25 or 26 at the moment. And then actually it's 30 right now. So it's not even 20, anything closer to 20. So if you look at right now, you will think this company is actually undervalued at the moment. EPS almost to $20, okay, and then a market cap of 448. That's basically what Netflix was lost just yesterday. Okay, almost to $50 billion. Economic mode, it has a white mode. In terms of capital allocation, the company are doing really well when it comes to reinvesting your money, generating more revenue, investing in the business and all of that stuff. Okay, annual dividend yield of 1.3%. 5-year growth rate of 12%, dividend growth streak of 16 years in a row, and then payout ratio of only 21. So they have room to improve that. Safety and dividend safety is only 71, which is very good. Okay, anything below, basically above 60 is quite good. Free cash flow 2.5, beta above 1, which is basically what we're looking for, less than 1. So it's above 1, so it's not that great, but it is quite volatile, I'll be honest with you. I own it. Some days it's in red, some days it's in the green. Current ratio basically is quite good because it's above 1. Profit margin, this is the bit that I love about this business, almost 27%. Return on equity, again, 85%. Okay, quarterly revenue growth of 42%, and then quarterly earnings growth of almost 57%. Now, in terms of the next 5 years, people are expecting about 19. These are the analysts from Yahoo Analyst, 19.7%. Growth every single year in the next 5 years. Simply Wall Street says 26% undervalued at the moment. Target price of $456 per share. Morningstar again says about 15% discount at the moment. Target price of $396 per share. TipRank says it's 26% undervalued. They expect the price to be at the end of this year. So this is 12-month target, whereas these two are intrinsic value and so on. $436 per share. And I believe this is a strong buy. I own it. I think I own about 6 shares. I'm definitely going to basically continue buying this in the next few weeks and months to come. So that's the first stock we're looking at today. Again, it's a safe business. It's got great profit margins. They've got lower PE ratios, which is very good. And according to the analysts, according to Simply Wall Street and Morningstar and TipRanks, they're all saying it's actually undervalued at the moment. So if you're interested, maybe look at the research, maybe look at that, a little bit more detail into the company, and look at a bit more about the numbers in the last 5 to 10 years, their revenue growth and the net profits and all of that good stuff. Okay, just if you're interested in that stock. The next one is Salesforce. It's another company that I own in my portfolio. This company basically helps other businesses out there to host their data, analyze the data, help them with their customer side of things. So what are customers buying, what their trends and all of that stuff. So they have amazing business there. They bought Slack very recently. I think it was in 2021. They bought Slack to add into their companies they own. This company, the way they grow right now, the way they grow in the business right now is not, although they're organically growing the business, they are also purchasing other businesses that they think that will add a value to the company, which is quite good as well. So the money is not, although they don't pay dividend, but they actually taking that money they making and reinvesting into the business, which is quite good. So right now trading $181 per share. PE is very, very high. Price to free cash flow is also quite high. In terms of EPS, is quite low, but obviously because it's still growing the business. Market cap of $184 per share. Economic moat of wide. Standard when it comes to capital allocation, they have $5.2 billion in the bank. Beta is quite low. Current ratio just above 1. And then profit margin and return on equity are still quite low. So I'm hopefully in the next 5 to 10 years, this will be a lot better. Like I said in many videos about when we talk about this business, I think this will be the Microsoft of tomorrow. I genuinely believe that. And quarterly revenue growth of almost 26%, and earnings growth from last year basically is basically unapplicable at the moment. And the next 3 years, we're expecting at least a 15% growth in the business. Simply Wall Street says it's almost 50% undervalued. Price target should be $374 per share. Morningstar 40% discount, $320 per share. TipRank 61% upside, and its price should be about $300 per share, which doesn't actually make sense. Let me double check this. Yeah, it's actually correct. So they're saying it's a strong buy, 300, and it's 65% upside at the moment. So yeah, more or less the same. I think I haven't updated. I did this research yesterday, so it basically went up, I think, quite a bit yesterday. 300 is basically their target price, and they asked basically overall it's a strong buy. I will say strong buy for me as well. I'm actually down quite a bit. In fact, I keep saying I'm down, but I haven't actually shown you. Let me quickly show you where that is. So Salesforce, as you can see, I've got 8 shares here, 5 or 6 shares in Freetrade, which I'm planning to move across very soon. But as you can see, I'm down by 18% right now. So I'm planning to add to that one. KLA, where is KLA? Let's go up there. Again, I was in the green, I think, when the market opened today. Right now it's in the red. That's what I meant by being a volatile stock. So both of them I'm down, but I'm definitely adding to it in the next few weeks. Right, so the next one is AMD. We've looked at AMD recently. Again, when you look at this company, okay, to be honest, I was looking for a computer very recently, and I went out and I was looking for high performance computers. And then I thought, you know what, let me do a little bit of research to find out what chips basically they use in all these computers, whether they are AMD or Intel. Majority of them, I was surprised that the high performance, the gaming ones, obviously they were AMD, but even some of the latest computers were actually using AMD. Before, it used to be mainly Intel, and then you've got high performance gaming ones just use AMD. This company, I didn't even know they used to own Global Foundries, which is quite interesting, because that to me means that their chips will be produced by Global Foundries. Okay, and they also bought this company not long ago, I think it was 2021. So incorporating all of that into this one business, that is amazing. Right, let's have a look at the numbers. Current price $91 per share, PE 35, and price to free cash flow is 30. So 35, 37, which is kind of quite high if you look at if you compare it to the sector. But if you compare it to like for like the other companies, like the Intels, whatever, this will be too expensive. Again, Intel is a different ballgame. Maybe look at companies like, I know it's not like for like, but Nvidia and so on. So EPS 2.57, market cap of $150 billion, economic mode of narrow, and then capital allocation, they're doing really well when it comes to that. Free cash flow here, $3.2 billion that they can reinvest in the business and do all sorts of things with it. Beta, so below 1 is what we're looking for, is above 1, so that tells me it's quite volatile. Current ratio above 1, which is very good, so they've got a lot of money. Next 12 months, anything happens, that they can cover their debt. Profit margin 19%, return on equity 47%. Now, quarterly revenue growth is about 49%. The earnings growth actually declined 45%. A lot of that maybe is with the fact that a lot of people were buying computers and all that stuff last year. I don't know what it is, but it's down. So it will be interesting to see when the new, a lot of the companies are reporting in the next few weeks. So it will be interesting to see what that looks like. Okay, so this will definitely get updated very soon. In terms of the next 5 years, about 30% in terms of earnings growth. So the next 5 years, we're expecting it at least to grow about 30%. And then Simply Wall Street says it's actually undervalued, which is very interesting. Okay, so $143 per share, that's what they're expecting. Right now it's about 90 something, so that's quite good. Morningstar, same thing again, and TipRanks is also saying the same. So all of them have agreed this company is actually undervalued, and this is probably the first time I have seen this. Now, having said that, because of the high PE, okay, if you're comfortable with the high PE, then by any means go for it. But because of the high PE, I would say it's a moderate buy for me, because you probably would want to have some sort of a margin of safety, like what we've seen with Cisco's and Intel's. You don't want to overpay for any stock, although the analysts are saying it is actually undervalued at the moment. Okay, if you own it already and you may be down, maybe this is a good time to actually buy a little bit more and average it down. If you start in a new position, I'm talking about. So if I see this stock, I haven't actually decided whether I want to add this to my portfolio or not, because I've got too many semis in my and I've realized a lot of them are the mobile side of things. So I need to look at the portfolio management kind of thing in the next few weeks. But generally, it's a great company. I absolutely love the business, and the fact that I went to the shops and looked around every single PC out there, whether it was Intel or AMD, and majority of them were AMD. Right, and the GPUs were all NVIDIA. I was quite interested. That was very interesting. So anyway, yeah, it's a great company. For me, it's a moderate buy at the moment. I will say if you own it, then that's fine. Just keep it, maybe average it down and add to it if you're basically down a little bit. If not, maybe just wait a little bit and just sit until it gets to maybe 85. I used to own this, by the way. I think when it was, I made quite a bit of money early on when it was like, I can't remember, it was I think 60, 40s or whatever it was, and then it kind of shot up in it. Right, so that is the next one, and the next company we're looking at is Microsoft. This is basically one of the safest companies out there. This is one of my biggest holdings out there. In my portfolio, currently trading $286 per share. At one point, I'm sure it was over $350 per share. It's gone down quite a bit. Beta and the price to free cash flow is still high, and EPS basically almost a 10. Market cap of $2.14 trillion. In terms of the numbers are amazing when it comes to this company. I'll tell you this much right now. In terms of capital allocation, they're doing absolutely brilliant. Dividend is not that big, but hey, it's out there. You get about $2, I think, per share. 5-year growth rate of 9%, 15 years of doing that, 25%, 27% payout ratio. So they have a massive room to improve. They can even make that 2% if they wanted to. Dividend safety, 99% safe. And then free cash flow of $60 billion. Okay, $60 billion. That's they can buy a whole company. And in fact, that's what they're doing right now with Activision, Blizzard, and so on. Beta, below 1. Current ratio, above 1. Profit margin of 38, almost 39, 49% return on equity, 20% revenue growth year on year, and earnings growth of 21%. Now, next 5 years, they're expecting about 15% growth every single year, which is absolutely amazing. And when it comes to all of these analysts, they are actually undervalued at the moment. So this is one of the companies I've always, I'm actually bullish on this company. So every time I talk about it, I feel like I'm just trying to persuade people to buy it, but genuinely I'm not, because I actually genuinely like the business. I understand it is easy for me to get my head around, and I think it's a strong buy right now. I'll be honest with you, right? I'll actually sleep well, like owning the Microsoft over AMD. Okay, that's how safe I think this company is. The next one we're looking at is Adobe, another business that I own right now in my portfolio. It's been down quite a bit. Right now trading $423 per share. P is quite high, but price to free cash flow is actually not that bad in comparison to the sector. EPS, okay, just about 10. Market cap of $202 billion. And then obviously when it comes to this, there's no comparison. There's not other companies out there that can actually do what Adobe is doing right now in terms of the software they provide and the subscription model and so on. Free cash flow is they've got about $6.8 billion. Beta above 1 at the moment, so a little bit volatile. Current ratio just above 1, so they've got enough to cover their debt in the next 12 months. Profit margin 30%, return on equity 35%, solid. Next 5 years, basically expecting to growth about 14%, but when it comes to the quarterly, they haven't been doing well, hence why the actually stock is down quite a bit. Okay, and then simply Wall Street valuation, I think there's a lot of it to do with maybe the COVID situation. I'm not sure what's going on, but I'm sure when they release their earnings, I'm sure it will be better than what it was this time last year. Simply Wall Street valuation 43%. They're expecting to pay $765. I think that's just a little bit of exaggeration. Morningstar, I like Morningstar at 615, that's more realistic. And also tip rank about 568, which is not bad. Still for me, it's a strong buy. Okay, I start buying when it was about 600 something. I'm down quite a bit. I say quite a bit. It's about 360 pounds basically down, or 14% down at the moment. So I'm definitely going to try to average that down. So all the companies that I've spoken about today is actually I'm down all of them, and hopefully in the next few months I can actually add a bit more to it. Although I'm being a little bit careful with basically putting too much into tech, because I own a lot more tech in terms of money wise than actually other sectors. So I'm trying to balance things out, but I will be buying a little bit more here and there. Well, that's the end of the video. That's basically the 5 companies that I wanted to talk about. Last video we talked about these, another great 5 companies in there. So I will do one more video just to look at maybe high speculative kind of companies. If you have any suggestions or any companies that you feel like you want to look at, you want us to look at, definitely let me know and I will add that to the list. I hope you're enjoying the videos, and if you are, please just subscribe to the channel. Let me know if you have any questions. As always, I'm trying to be transparent with you guys. So that's the end of that video. Have a great day. Take care.